There's a moment almost everyone experiences at some point in life. You walk into a dealership to buy a car, or sit across from a real estate agent discussing your dream home, and before you even finalize your decision, one question is already waiting for you. Will you be financing through a bank? It sounds routine, almost harmless, but behind that simple question lies a deeply structured financial system, one that has been built, refined, and optimized over decades, backed by trillions of dollars and supported by global financial institutions. This isn't fluky. It's strategy, and the data proves it. Let's start with what banks actually do. Contrary to popular belief, banks are not primarily in the business of storing money. They are in the business of lending it. According to the Federal Reserve, 2023, approximately 58% of total revenue for U.S. banks comes from net interest income. That means more than half of what banks earn is generated from the difference between the interest they charge borrowers and the interest they pay depositors. This is not a side activity. It is the backbone of the banking system. When a bank encourages you to finance your car or home through them, it is directly tapping into its primary revenue engine. Now consider the sheer scale of this system. As of 2023, total mortgage debt in the United States reached $12.44 trillion, according to the Federal Reserve Bank of New York. At the same time, auto loan debt stood at $1.6 trillion. These are not small markets. They are massive, structured ecosystems that generate predictable, long-term income streams. Every mortgage payment, every car installment, month after month, year after year, feeds into this system. And unlike many other forms of income, these payments are scheduled, contractual, and often secured by collateral. That means if a borrower defaults, the bank still has a claim on a tangible asset, the house or the vehicle. But here's where it becomes even more strategic. These loans are not short-term transactions. Mortgages typically last 15 to 30 years, while auto loans average about 68.48 months. 2023, Experian Automotive Report. That's not just lending, that's a long-term financial relationship. Over decades, a single mortgage can generate thousands, sometimes hundreds of thousands, in interest payments alone, depending on the loan size and rate. And this isn't speculative. It's built into the structure of amortized loans, where early payments are heavily weighted toward interest rather than principal. From the bank's perspective, this creates something extremely valuable: predictable cash flow. In financial terms, predictability reduces uncertainty, and reduced uncertainty increases stability. This is one of the reasons why lending is considered a cornerstone of banking. According to the Federal Deposit Insurance Corporation, FDIC, the average net interest margin for U.S. banks was 3.3% in Q4 2023. That percentage might seem small at first glance, but when applied across trillions of dollars in loans, it translates into substantial revenue. Now step back and look at the bigger picture. Globally, the Bank for International Settlements, 2022, estimates that total banking sector assets exceed $180 trillion, with a significant portion tied to lending activities. This means that when banks encourage financing, they are not just making a sale. They are sustaining a global financial structure that depends on continuous lending and repayment cycles. But the strategy doesn't end with interest income. Once you take a loan from a bank, you are no longer just a customer. You become a long-term client within their financial ecosystem. Research from the McKinsey Global Banking Report, 2022, confirms that banks actively use lending relationships to expand into other financial services, such as credit cards, insurance, and investment products. While exact cross-selling revenue percentages vary and are not universally standardized, the model itself is well documented. Acquire the customer through a major financial product, then deepen the relationship over time. Think about it. If your mortgage is tied to a bank for 20 or 30 years, where are you more likely to open your savings account? Apply for a credit card? Consider investment advice? The answer, statistically and behaviorally, often points back to the same institution. This is not accidental. It is a retention strategy built on long-term financial dependency and convenience. There's also another critical factor: risk management through collateral. Unlike unsecured loans, mortgages and auto loans are backed by physical asset. If a borrower fails to repay, the bank has the legal right to recover its losses by repossessing and selling the asset. This significantly reduces risk compared to other forms of lending. It's one of the reasons why these types of loans are so heavily promoted. They offer a balance of profitability and security. Historically, this system didn't appear overnight. Modern mortgage lending expanded significantly after World War II, particularly with the introduction of government-backed programs like those from the Federal Housing Administration, FHA. Auto financing followed a similar trajectory, growing rapidly alongside mass automobile production in the 20th century. Over time, these financing models became standardized, institutionalized, and deeply integrated into the global economy. So when a bank encourages you to finance your car or home through them, it's not just offering convenience, it's activating a system that has been engineered for decades. A system where interest payments generate consistent revenue, long-term loans create stable cash flows, collateral reduces risk, and customer relationships open doors to additional financial product. And perhaps the most important part? This system works not because it forces people into it, but because it aligns with real human needs: the need for housing, transportation, and financial accessibility. Banks don't just want you to finance, they rely on it. But to truly understand why banks push so strongly for financing, you have to look beyond just interest and scale, and step into how money itself moves inside the banking system. Because here's something most people don't realize: when you deposit money into a bank, that money doesn't just sit there waiting. It becomes part of a much larger financial cycle. Banks use deposits to fund loans, and this cycle is formally embedded in what economists call the fractional reserve banking system, a globally recognized and regulated framework. While exact reserve requirements vary by country and have changed over time, the principle remains consistent. Banks keep a portion of deposits and lend out the rest, generating income from the spread between borrowing and lending rate. This model is supported by central banks and regulatory institutions. For example, the Federal Reserve, 2020, reduced reserve requirement ratios for U.S. banks to 0%, allowing greater flexibility in lending, although banks are still constrained by capital requirements under frameworks like Basel III, Bank for International Settlements. These capital rules require banks to maintain a minimum level of equity relative to their risk-weighted assets, ensuring stability even as lending expands. This is not a loophole. It is a design system that allows banks to scale lending while managing systemic risk. Now connect this back to you, the borrower. When you take out a mortgage or auto loan, the bank is not simply handing over existing money. It is effectively creating a loan asset on its balance sheet. According to standard accounting practices used in banking, loans are recorded as assets because they generate future income. At the same time, your repayments, monthly, predictable, contractually obligated, become incoming cash flows that strengthen the bank's financial position over time. This is why long-term loans are so valuable. They convert today's lending decision into decades of structured income. Let's bring in another verified dimension: loan securitization. This is where things move from simple lending into complex financial engineering. In many cases, especially with mortgages, banks do not hold loans for their entire duration. Instead, they bundle large numbers of loans together and sell them as financial instruments known as mortgage-backed securities, MBS. According to data from Ginnie Mae, Fannie Mae, and Freddie Mac 2023, trillions of dollars in U.S. mortgages are securitized and sold to investors. This allows banks to recover liquidity quickly and issue even more loans. In other words, financing your home doesn't just generate interest. It can also be transformed into tradable financial assets within global capital market. This process became widely known during the 2008 financial crisis, when excessive risk-taking in mortgage securitization led to systemic failure. Since then, regulations have tightened significantly, but the core mechanism still exists and remains a fundamental part of modern banking. Today, securitization is more controlled, with stricter underwriting standards and regulatory oversight, but it continues to play a key role in how banks manage and expand their lending capacity. Another critical layer is interest rate policy, controlled by central bank. When central banks adjust interest rates, they directly influence borrowing behavior. For instance, during periods of low interest rates, such as the global economic response to COVID-19 2020 to 2021, borrowing tends to increase significantly. According to the World Bank 2022, global credit expanded rapidly during this period due to accommodative monetary policies. For banks, this environment is ideal. Lower borrowing costs encourage more people to finance homes and vehicles, increasing loan volumes even if margins per loan are slightly reduced. But the system also works in reverse. When interest rates rise, borrowing slows, but the loans that are already issued, especially those with variable rates, can generate higher returns. This dynamic ensures that lending remains profitable across different economic cycles, although the level of demand may fluctuate. Again, this is not speculation. It is a well-documented relationship between monetary policy and credit market. Now consider the psychological and behavioral side, supported by financial research. Large purchases like homes and cars often exceed immediate purchasing power, making financing not just an option, but a necessity for most consumers. According to housing data from the U.S. Census Bureau, 2023, the median home price far exceeds median annual household income, reinforcing the reliance on mortgage financing. This structural gap between income and asset prices is one of the key reasons why lending markets remain essential, and why banks continue to promote financing options. At the same time, auto financing has become increasingly normalized. The Experian Automotive Finance Market Report 2023 shows that a significant majority of new vehicle purchases in the U.S. involve financing rather than full cash payment. Exact percentages vary by quarter and are not universally fixed, but the trend is consistent and well documented across multiple reports. Financing dominates large consumer purchases. And then there's the concept of lifetime customer value, a metric widely used in banking strategy. While exact numerical values differ by institution and are not publicly standardized, the principle is confirmed by industry research. A customer who holds multiple financial products, such as a mortgage, auto loan, credit card, and savings account, is significantly more valuable over time than a single product customer. This is why banks invest heavily in acquiring borrowers. A mortgage is not just a loan, it is an entry point into a long-term financial relationship that can span decades. Finally, there is the regulatory and institutional trust factor. Banks operate under strict oversight from central banks, financial regulators, and international frameworks. This structure provides a level of security and standardization that encourages consumers to borrow through formal financial institutions rather than informal channels. In many countries, government-backed mortgage programs further reinforce this system by reducing risk for both lenders and borrowers. So when you look at the full picture, the question is no longer why banks want you to finance your car or home. It becomes almost inevitable. The system is designed around it. From interest income and balance sheet growth to securitization, monetary policy, and customer retention, every layer of modern banking is interconnected with lending. And the next time someone asks you, will you be financing through the bank? You'll know that behind that simple question lies a global financial engine, powered not by chance, but by design.